Let's talk about the moment when everything almost stopped. Not in the way of a sudden earthquake or a bomb dropping, but in the slow, terrifying way that water drains from a bathtub. Steadily, inevitably, until you're left staring at what remains. The year was 2008, and the world stood at the edge of something it hadn't seen since the 1930s. A complete collapse of the financial system. Not just one bank failing or one market dipping, but the entire architecture of money, credit, and trust threatening to crumble into dust. This is the story of how we got there. How ordinary decisions about houses and mortgages snowballed into a crisis that touched every corner of the globe. How instruments with names like collateralized debt obligations and credit default swaps, things most people had never heard of, became the kindling for an economic inferno. And how, when the flames finally reached their peak, millions of people lost their homes, their jobs, their savings, their sense of security. But before we arrive at September 2008, when Lehman Brothers filed for bankruptcy and sent shockwaves through every financial market on Earth, we need to go back. Back to the beginning of the century, when the air was different, when optimism ran high and housing prices seemed to know only one direction: up. So settle in, dim the lights if you like, let the weight of the day fall away, because we're going to walk through this story together, slowly and carefully, examining how one of the worst economic disasters in modern history unfolded. Not with judgment, but with understanding. Not with panic, but with the steady patience of someone looking back at a storm that has already passed. Let's begin where many stories of disaster begin, with hope. In the early years of the 2000s, if you had walked through any suburban neighborhood in America, you would have seen something remarkable happening. Houses were going up everywhere. New developments sprawled across former farmland, their streets winding like fresh scars through dirt that had never known pavement. The sounds of construction hummed in the background. Hammers, saws, the beep of trucks backing up. The air smelled of fresh lumber and paint. This was the American dream in its most tangible form. Home ownership. For generations, owning a home had represented stability, security, a piece of the future you could touch. And in the early 2000s, that dream seemed more accessible than ever before. Interest rates had dropped to historic lows after the Federal Reserve cut them aggressively following the dot-com bubble burst and the September 11th attacks. Money was cheap, credit was easy, and banks, those institutions we trusted to be conservative and careful, were practically begging people to borrow. If you wanted to buy a house, you could, even if your credit history was spotty, even if your income was modest or difficult to verify, even if you couldn't afford a traditional down payment. There was a loan for everyone, or so it seemed. The industry had a name for these loans given to borrowers who didn't quite meet the standard qualifications: subprime mortgages. The term sounds technical, almost benign, but beneath that bland terminology lay something more volatile than most people realized. Subprime lending wasn't new. It had existed for years as a small corner of the mortgage market, serving people who needed second chances or who fell just outside the boundaries of conventional financing. But in the early 2000s, something shifted. Subprime lending exploded. By 2006, nearly 20% of all mortgage originations were subprime, compared to less than 10% just a few years earlier. Lenders weren't just offering these loans, they were actively marketing them, packaging them as opportunities, as paths to prosperity. The structure of these loans often followed a similar pattern. They would start with a low introductory interest rate, sometimes called a teaser rate, that made the monthly payments seem manageable, affordable even for someone stretching their finances. But after a few years, that rate would adjust upward, sometimes dramatically. A mortgage payment that had been $100-200 a month could suddenly jump to $2,000 or more. For many borrowers, especially those with tight budgets, this adjustment would prove impossible to meet. But in those early years, when housing prices were climbing month after month, this seemed like a reasonable risk. If your payment became unmanageable, you would simply refinance based on the increased value of your home. Or you could sell the house for more than you paid and walk away with a profit. The system worked as long as one crucial assumption held true, that housing prices would continue to rise. And they did rise. Between the late 1990s and 2006, home prices in the United States increased by 124%. In some markets, particularly in California, Florida, Arizona, and Nevada, the gains were even more spectacular. Houses that had sold for $200,000 were now worth $400,000 or $500,000. Ordinary people were sitting on hundreds of thousands of dollars in equity, wealth they had never imagined possessing. It felt like magic, like the rules of economics had been rewritten. Families who had never owned property before were signing mortgages. Investors were buying second and third homes, planning to flip them for quick profits. Real estate seemed like the safest bet in the world. After all, people would always need somewhere to live. Land was finite. Demand was strong. What could possibly go wrong? The atmosphere in those years carried a particular kind of energy. You could feel it in coffee shops where people talked about their home's appreciation as if it were a stock portfolio. You could see it in television shows dedicated to house flipping and real estate investment. You could hear it in the casual conversations at dinner parties where friends compared the value of their homes the way previous generations might have discussed their children's achievements. Everyone wanted in, and the financial industry was more than happy to oblige. Mortgage brokers, those middlemen who connected borrowers with lenders, proliferated like weeds after rain. Many of them worked on commission, earning fees for each loan they originated. This created a powerful incentive. The more mortgages they could produce, the more money they made. Quality didn't matter as much as quantity. Documentation requirements became looser. Income verification became optional. Some loans were even labeled as NINA loans, no income, no assets. As long as you could fog a mirror, the joke went, you could get a mortgage. Lenders weren't worried about the risk because they weren't planning to hold on to these mortgages. This is crucial to understanding what happened next. In the old model of banking, a bank would give you a mortgage and then collect your monthly payments for the next 30 years. The bank bore the risk. If you defaulted, the bank lost money. This created a natural incentive for the bank to be careful, to verify your income, to make sure you could actually afford the loan. But by the 2000s, a new model had taken over. It was called originate to distribute. Banks and mortgage companies would originate the loans, meaning they would sign the paperwork and hand over the money. But then, almost immediately, they would bundle these mortgages together and sell them off to investors on Wall Street. The loans would be packaged into securities, complex financial instruments that could be traded like stocks or bonds. This meant the original lender no longer bore the risk. They got their money back right away, plus a fee for originating the loan. The risk was passed along to whoever bought the securities. This might sound like a clever way to spread risk, to distribute it across many shoulders, so no single institution would be crushed if things went wrong. And in theory, that's exactly what it was supposed to do. But in practice, it created a dangerous disconnect. The people making the loans had no incentive to care whether the borrowers could actually repay them. Why would they? By the time a borrower defaulted, the loan would be someone else's problem. The result was a massive erosion of lending standards, a race to the bottom where profit mattered more than prudence. And yet for a while, it all seemed to work. Housing prices kept rising, borrowers kept making payments, and Wall Street kept buying mortgages, hungry for more product to feed into their securitization machine. The system hummed along, generating enormous profits for everyone involved. Mortgage brokers made commissions, banks made fees, investment firms made trading profits. Even borrowers, as long as housing prices rose, seemed to come out ahead. It felt like everyone was winning. But beneath the surface, pressure was building. Not the kind you could see or measure easily. Not the kind that showed up in quarterly earnings reports or housing price indices. It was the pressure of unsustainable growth, of risks being hidden rather than managed, of a collective delusion that this time would be different. That the old rules of economics, the ones about risk and return and the relationship between debt and income, no longer applied. In those quiet suburban neighborhoods, in those new developments with their fresh paint and manicured lawns, families were moving in with hope and excitement. They had no idea that the homes they had just bought were part of a much larger system, a system that was becoming more fragile with each passing month. They couldn't see that their mortgages, once they were signed, would be sliced and diced and mixed with thousands of other mortgages, transformed into abstract financial products with incomprehensible names and sold to pension funds and insurance companies and foreign banks on the other side of the world. They were just trying to build a life, to have a place of their own, to give their children a backyard to play in. And in that desire, that fundamentally human longing for shelter and stability, they had become unwitting participants in something much more dangerous than they could have imagined. A house of cards built on borrowed money and borrowed time. A structure that would, before long, begin to shake. But we're getting ahead of ourselves. Before the collapse, before the panic, before the emergency meetings and the bailouts and the headlines screaming about economic catastrophe, there was a period of quiet confidence. A sense that innovation had solved the old problems. That financial engineering had created a new kind of safety. Let's talk about that engineering. About the arcane instruments and mathematical models that transformed mortgages into something entirely different. Something that would, in the end, amplify the crisis beyond anyone's imagining. Once upon a time, mortgages were simple things. You borrowed money from a bank to buy a house. You paid the bank back over 30 years with interest. The bank held onto the mortgage, collected your payments, and made a profit from the interest. If you couldn't pay, the bank would foreclose on your house, sell it, and try to recoup its losses. The relationship was direct. The risk was contained. Everyone understood how it worked. But by the 1990s and early 2000s, Wall Street had discovered that mortgages could be transformed into something more liquid, more tradable, more profitable. The key innovation was called securitization. It's a word that sounds technical and perhaps a bit boring, but the concept behind it would prove to be one of the most consequential financial developments of the modern era. So let's slow down and really understand what it meant. Here's how it worked. A bank would originate hundreds or thousands of mortgages, all those loans to families buying homes across the country. Instead of keeping those mortgages on its own books, the bank would sell them to an investment bank on Wall Street. The investment bank would then pool all these mortgages together, thousands of them, into one large bundle. This bundle would be turned into a security, a financial instrument that could be bought and sold. These securities were called mortgage-backed securities, or MBS. The basic idea was actually quite old. The government-sponsored enterprises Fannie Mae and Freddie Mac had been creating mortgage-backed securities since the 1970s, primarily with prime mortgages, the ones given to borrowers with good credit and stable incomes. But in the 2000s, private investment banks expanded this model dramatically, creating MBS backed by subprime and other risky mortgages. They issued mortgage-backed securities at unprecedented levels, fueled by the housing boom. From an investor's perspective, buying an MBS seemed like a good deal. You would receive regular payments, just like the homeowners were making their monthly mortgage payments. And because the security was backed by hundreds or thousands of different mortgages from different parts of the country, it seemed well diversified. If a few borrowers in Florida defaulted, it wouldn't matter much because most of the borrowers in California and Texas and Ohio were still paying. The risk, so the theory went, was spread so thin that it essentially disappeared. To make these securities even more attractive, the investment banks would slice them into different layers, or tranches. This is where things start to get more complex, but stay with me, because this slicing was crucial to what happened next. Imagine a waterfall of mortgage payments flowing into a pool. The first tranche, called the senior or AAA tranche, would get paid first. It had first claim on all the mortgage payments coming in. Because it got paid first, it was considered the safest. Rating agencies, the firms responsible for evaluating the riskiness of investments, would often give these senior tranches their highest rating, AAA, the same rating given to US Treasury bonds. The middle tranches, sometimes called mezzanine tranches, would get paid next. They were riskier because they only got paid after the senior tranche had received its money. If a significant number of homeowners stopped paying their mortgages, the middle tranches might not receive their full payments, so these tranches were rated lower, perhaps AA or A. At the bottom were the equity tranches, sometimes called toxic waste in the industry. These tranches got paid last. If there was any wave of defaults, The equity tranches would absorb the losses first. They were the riskiest, but they also offered the highest returns to compensate for that risk. Hedge funds and other aggressive investors would often buy the equity tranches, betting that defaults would remain low and they could earn outsized profits. This tranching structure was supposed to be a sophisticated form of risk management. It allowed different types of investors with different risk appetites to invest in the mortgage market. Conservative pension funds could buy the safe AAA tranches. More aggressive investors could buy the riskier tranches. Everyone could find something suitable. And Wall Street made money on every transaction, earning fees for creating these securities, for structuring them, for selling them, for trading them. But there was a problem lurking in this elegant mathematical structure. The whole system depended on one critical assumption, the same assumption that was holding up the housing market itself, that defaults would remain relatively low and that losses, when they occurred, would be spread randomly across different regions and different types of borrowers. In other words, the system assumed that there wouldn't be a massive, nationwide collapse in housing prices that would cause millions of borrowers to default simultaneously. This assumption wasn't as solid as it appeared. Yes, historically, nationwide declines in home prices had been rare in the United States, but that didn't mean they were impossible. And more importantly, the very structure of subprime lending, with its teaser rates and adjustable payments and loose standards, was creating a new kind of risk, one that wasn't adequately captured in the models Wall Street was using. But Wall Street didn't stop with mortgage-backed securities. There was another layer of complexity, another financial innovation that would make the eventual crisis even worse. These were called collateralized debt obligations, or CDOs. If you thought mortgage-backed securities were complicated, CDOs were complexity on top of complexity, abstraction layered upon abstraction. Here's what happened. Investment banks would take the lower-rated tranches of mortgage-backed securities, the ones that were harder to sell because they were riskier, and pool them together. Then they would slice this pool into new tranches, creating a new security called a CDO. Through mathematical modeling and the magic of diversification, the senior tranches of these CDOs would often receive AAA ratings, even though they were built from pieces of mortgage-backed securities that were themselves rated much lower. Let that sink in for a moment. You could take a bunch of AA or BBB rated securities, pool them together, and somehow create a new security that was rated AAA. It was financial alchemy, turning lead into gold through the power of mathematical models and the assumptions built into them. And like alchemy, it sounded too good to be true. But the rating agencies signed off on it. Moody's, Standard & Poor's, Fitch, the big three rating agencies that investors relied on to assess risk, gave these CDOs their blessing. Between 2000 and 2007, Moody's rated nearly 45,000 mortgage-related securities as AAA. In 2006 alone, Moody's put its AAA stamp of approval on 30 mortgage-related securities every working day. These ratings mattered enormously because many institutional investors, like pension funds and insurance companies, were only allowed to invest in securities rated AAA. The rating agency's seal of approval opened the door for these CDOs to be sold worldwide. The CDO market exploded. Between 2003 and 2007, Wall Street issued almost $700 billion in CDOs that included mortgage-backed securities as collateral. The fees were enormous. Creating and selling these securities generated billions in revenue for investment banks. Traders who specialized in CDOs received million-dollar bonuses. The whole industry was in a frenzy, churning out product as fast as the market could absorb it. But this frenzy created a perverse dynamic. To create CDOs, investment banks needed to buy the lower tranches of mortgage-backed securities. This created demand for those tranches, which in turn created demand for more mortgage-backed securities. And to create more mortgage-backed securities, you needed more mortgages. So the demand for mortgages intensified. Lenders lowered their standards even further, creating even riskier loans. Because Wall Street was hungry for product, the system was feeding on itself, growing larger and more unstable with each passing month. Some people saw the danger. Warren Buffett famously called derivatives a broader category that included many of these complex securities, financial weapons of mass destruction. A few economists and analysts warned that the housing market was overheating, that prices couldn't keep rising forever, that the lending standards had become dangerously lax. But these warnings were dismissed. The housing market was strong, defaults were low, and everyone was making too much money to want to believe that anything could go wrong. Deep in the complexity of these CDOs was another problem. They were essentially impossible to value accurately. When you have a pool of mortgages, you can make reasonable estimates about how many will default based on historical data. But when you have a CDO made up of tranches of mortgage-backed securities, which are themselves pools of thousands of mortgages, the complexity becomes overwhelming. How do you value something that's 3 steps removed from the underlying asset? What happens when the models you're using don't account for the possibility that housing prices might fall nationwide? The people creating these securities often didn't fully understand the risks themselves. There are stories of traders and executives who were shocked when they later discovered what was actually inside the CDOs they had been selling. The instruments had become so complex, so opaque, that even the experts struggled to see through them. And if the experts couldn't understand them, what chance did ordinary investors have? Yet pension funds in Norway, insurance companies in Germany, regional banks in Australia, they all bought these CDOs, trusting in the AAA ratings, trusting in the sophistication of Wall Street, trusting that someone, somewhere, had done the hard work of assessing the true risk. That trust would prove tragically misplaced. By 2006, the mortgage industrial complex, as it came to be called, was operating at full capacity. Lenders were churning out mortgages. Wall Street was packaging them into securities. Rating agencies were rubber stamping them with AAA ratings. And investors around the world were buying them, believing they were safe, diversified investments. Trillions of dollars in capital had become tied up in instruments built on subprime mortgages, on loans to people who, in many cases, would struggle to repay once their teaser rates expired and their payments jumped. The machine hummed efficiently, generating fees and profits at every stage, from the mortgage broker who earned a commission for signing the borrower, to the investment bank that earned fees for packaging the securities, to the rating agencies that earned fees for rating them, to the traders who earned bonuses for selling them. Everyone had an incentive to keep the machine running. No one had an incentive to stop and ask whether the underlying mortgages were actually sound. And the borrowers themselves, sitting in their homes, making their payments month after month, had no idea that their mortgages had been sliced into tiny pieces and scattered across the global financial system. They didn't know that somewhere in New York, their mortgage was part of a CDO being sold to a pension fund in Japan. They didn't know that their ability to make their payments, or their inability, would eventually matter to people on the other side of the world. For a while, everything held together through a kind of collective faith. Faith that housing prices would keep rising. Faith that borrowers would keep paying. Faith that the models were correct. Faith that the rating agencies knew what they were doing. Faith that Wall Street's financial engineering had actually made the system safer rather than more fragile. But faith, as we would soon discover, is not the same as stability. And when that faith began to crack, the consequences would cascade through the system with terrifying speed. But before we get to the cracks, before we watch the whole edifice begin to tremble, we need to talk about another crucial player in this story, not the banks or the borrowers or Wall Street. We need to talk about the organizations that were supposed to be the gatekeepers, the ones whose job was to tell the truth about risk, the credit rating agencies. The credit rating agencies, Moody's, Standard & Poor's, and Fitch, might not be household names, but their influence over the financial system was immense. Their job was simple in principle: evaluate the riskiness of various investments and assign them a grade. The grade scale ranged from AAA, the highest and safest rating, down through AA, single A, triple B, and into what was called junk territory, bonds rated below investment grade. These ratings mattered because they determined who could buy what. Many institutional investors, the pension funds managing retirement money for millions of workers, the insurance companies holding reserves to pay future claims, were restricted by their own rules or by regulations to invest only in securities rated investment grade or higher. If a security was rated AAA or AA, it could be purchased by these conservative investors. If it was rated junk, it couldn't. So the difference between a AAA rating and a single A rating wasn't just academic. It determined the market for a security, its price, its liquidity, everything. This gave the rating agencies enormous power. A thumbs up from Moody's or S&P could be worth millions or even billions of dollars to an investment bank trying to sell a new security. And conversely, a downgrade could cause a security's value to plummet overnight. Everyone in the financial world watched the rating agencies closely, hanging on their pronouncements like ancient Greeks consulting the oracle at Delphi. The rating agencies claimed to be independent and objective. They said they were like journalists or academic researchers, simply calling it as they saw it, applying rigorous analytical methods to assess risk. But there was a problem with this picture, a fundamental conflict of interest built into the business model. The rating agencies weren't paid by investors who use the ratings. They were paid by the investment banks that created the securities being rated. This was called the issuer pays model, and it created exactly the perverse incentives you might imagine. If you're an investment bank about to issue a CDO, you want a good rating, ideally a AAA rating. So you shop around among the rating agencies, looking for the one that will give you the rating you need. If one agency tells you your CDO will only get a AA rating, you might go to a different agency. The agencies knew this. They knew that if they were too conservative, too tough on ratings, they would lose business to their competitors. So there was a race to be friendly, to find ways to justify higher ratings, to keep the investment banks happy. The fees were substantial. Rating structured finance products like CDOs was far more lucrative than rating traditional corporate bonds. The complexity meant the work was more specialized, and the rating agencies could charge premium fees. During the boom years, revenue from rating mortgage-related securities soared. Moody's and S&P became extraordinarily profitable. Their stock prices rose dramatically. Their employees received large bonuses. Everyone was winning, as long as the ratings held up. But here's the thing about ratings. They're not predictions of the future. They're assessments of probability based on models and assumptions. And those models and assumptions, in the case of mortgage-backed securities and CDOs, turned out to be deeply flawed. The models assumed that housing prices would continue to rise, or at worst plateau. They didn't seriously consider the possibility of a nationwide decline. The models assumed that defaults in different regions would be uncorrelated, that a wave of foreclosures in Florida wouldn't spread to California. They didn't account for the possibility that a broad economic shock could trigger defaults everywhere simultaneously. Perhaps most critically, the models didn't adequately consider the quality of the underlying mortgages. As lending standards deteriorated and riskier subprime loans proliferated, the ratings should have reflected that increased risk. But they didn't, at least not proportionally. The rating agencies relied heavily on historical data about mortgage defaults. And historically, default rates on mortgages had been relatively low, even for subprime borrowers, because housing prices had been rising for so long. The models essentially assumed that the future would look like the past. They couldn't imagine, or chose not to imagine, a fundamentally different scenario. There were warning signs. Some analysts at the rating agencies were raising concerns. There are memos and emails that later surfaced showing that some employees knew the models were inadequate, that the assumptions were shaky, that the pressure to give good ratings was overwhelming the analytical process. But these concerns were overridden. The business was too profitable, the momentum was too strong, and besides, no one else seemed worried. If S&P started being really tough on ratings, Moody's or Fitch would just take the business. It was a prisoner's dilemma, and everyone chose defection, so the AAA ratings kept coming. CDOs that were built on shaky subprime mortgages received the same rating as US Treasury bonds, considered the safest investment in the world. This had profound consequences. It meant that conservative investors, who would never have touched subprime mortgages directly, ended up owning them indirectly through these CDOs. pension funds in small towns across America, managing the retirement savings of teachers and firefighters, bought CDOs thinking they were making safe, conservative investments. German regional banks, managing depositors' money, bought them. Insurance companies, holding reserves to pay future claims, bought them. All based on the faith that AAA meant safe. And then there was the matter of leverage. If you're a financial institution and you're holding assets rated AAA, you don't need to hold much capital in reserve. The regulatory rules assumed that AAA assets were so safe that you could borrow heavily against them. This was leverage. You could take $1 of your own money, borrow 9 more, and buy $10 worth of AAA-rated securities. If those securities paid even a modest return, your profits on your initial dollar would be magnified tenfold. Wall Street firms used this logic aggressively. They bought enormous quantities of mortgage-backed securities and CDOs, financing these purchases with borrowed money. Some firms were leveraged 30-to-1 or more, meaning they had borrowed $30 for every dollar of their own capital. As long as the securities held their value and kept generating income, this was enormously profitable. But it also meant these firms were extraordinarily vulnerable. If the value of their securities fell by just a few percentage points, their entire capital base could be wiped out. And the rating agencies, by handing out AAA ratings so liberally, had essentially enabled this leverage. They had told the financial system that these securities were safe, and the system had believed them, borrowing and betting based on that belief. It was a collective delusion, but one backed by the supposed authority and expertise of the rating agencies. As 2006 turned to 2007, some people started to notice something odd. Housing prices, which had been rising for so long, began to level off. In some markets, they even started to decline. The inventory of unsold homes was rising. Builders were reporting slower sales. And something else was happening, more quietly. Mortgage default rates were beginning to tick upward, not dramatically at first, just a slight increase, easy to explain away as a normal fluctuation. But the trend was there for anyone paying attention. The rating agencies should have been paying attention. As defaults rose, they should have been reassessing their models, their assumptions, their ratings. Some adjustments were made, but slowly and reluctantly. The agencies seemed to be in denial, unwilling to believe that something fundamental had changed. Or perhaps they were simply afraid of what acknowledging the problem would mean. Because if they started downgrading all those mortgage-backed securities and CDOs, if they admitted their ratings had been wrong, the consequences would be catastrophic. Investors would lose confidence, prices would plummet, lawsuits would follow, the agencies themselves would be blamed. So they moved slowly, too slowly, and by the time they finally began issuing mass downgrades in 2007 and 2008, the damage was already done. In the first 3 quarters of 2008, rating agencies made almost 40,000 downgrades of mortgage-related securities, far exceeding the cumulative number of downgrades for the entire period from 2000 to 2007. Many securities that had been rated AAA were downgraded to junk. Nearly half of all AAA-rated CDO tranches issued between 2005 and 2007 were either downgraded to junk status or lost principal by 2009. These downgrades wreaked havoc. When a security was downgraded, institutional investors who were only allowed to hold investment-grade securities had to sell them immediately. But who would buy? Everyone was trying to sell at the same time. Prices collapsed. What had been worth 100 cents on the dollar might suddenly be worth 50 cents, or 20 cents, or nothing at all. This created what's called a fire sale, a panicked dumping of assets at whatever price could be found. For the banks and investment firms holding these securities, often purchased with heavy leverage, the downgrades meant disaster. Under accounting rules, they had to mark these securities to market, meaning they had to record the losses on their balance sheets. Firms that had appeared healthy and profitable suddenly reported billions in losses. Their capital ratios deteriorated. They faced margin calls, demands from their lenders to post more collateral or pay back loans. And in many cases, they simply couldn't. The liquidity that had once flowed so freely now dried up. No one wanted to lend. No one wanted to buy. Everyone wanted to hide and wait for the storm to pass. The rating agencies would later be investigated and criticized heavily. Congressional hearings brought to light emails and internal communications showing how the agencies had prioritized market share and revenue over analytical rigor. Some saw the agencies as the villains of the crisis, complicit in a massive fraud. Others viewed them as simply incompetent, captured by flawed models and their own groupthink. The truth, as usual, was probably somewhere in between. They were neither evil nor stupid, but rather human institutions caught in a system where the incentives rewarded optimism and punished skepticism. Where everyone believed the good times would last forever, and anyone who questioned that belief was dismissed as a pessimist or a party pooper. But whatever the reason, whatever the mix of incompetence and incentives and ideology, the result was the same. The rating agencies had failed in their most basic function. They had told the world that risky assets were safe. They had given their stamp of approval to securities that would later prove nearly worthless. And in doing so, they had helped inflate a bubble that would eventually burst with devastating consequences. The failure of the rating agencies wasn't the only cause of the crisis, but it was a critical enabling factor. Without their AAA ratings, the CDO market couldn't have grown so large. Without their blessing, conservative investors wouldn't have bought these securities. Without their reassurance, the system wouldn't have become so over-leveraged and interconnected. They were the gatekeepers who opened the gates and let everyone rush through, and then watched in horror as what came next unfolded. By late 2006 and early 2007, if you knew where to look, you could see the tremors. Small cracks in the foundation that would, before long, split into fissures and then chasms. The housing market, which had seemed invincible, was beginning to show signs of strain. Prices in some cities stopped rising and actually began to fall. The inventory of unsold homes was climbing, new housing starts were declining, and most ominously, the default rate on subprime mortgages was starting to rise. These weren't dramatic changes at first, just a percentage point here, a few basis points there, the kind of movements that could be written off as statistical noise or seasonal adjustments. But for those paying close attention, the pattern was clear. Something was shifting. The machine that had hummed so smoothly for years was beginning to sputter. The first big warning came in early 2007. New Century Financial, one of the largest subprime mortgage lenders in the country, announced that it was facing serious financial difficulties. In April 2007, the company filed for Chapter 11 bankruptcy protection, citing increasing defaults and the tightening of credit from its lenders. New Century had originated $60 billion in subprime mortgages in 2006 alone. Now it was gone, wiped out by the very loans it had been making. The bankruptcy sent a ripple through the financial industry. If a major subprime lender could fail this suddenly, what did that say about the health of the broader mortgage market? But the reaction was muted. Most analysts and investors treated New Century's failure as an isolated event, a problem with one poorly managed company, rather than a symptom of something systemic. The stock market barely reacted. Housing prices in most markets were still holding up. Life went on. But behind the scenes, in the bowels of Wall Street's trading floors and risk management departments, people were starting to get nervous. The first signs of trouble appeared in a corner of the financial system that most people had never heard of: the market for asset-backed commercial paper. This was a way for financial institutions to borrow money short-term, often overnight, by using securities as collateral. It was a crucial part of the plumbing of the financial system, allowing banks and investment firms to manage their daily cash flow needs. In August 2007, this market suddenly froze. Investors who had been happily lending money overnight against mortgage-backed securities suddenly refused to do so. They didn't trust the collateral. They were worried that the mortgage-backed securities might be worth less than claimed. And if you're lending overnight, you want to be absolutely sure you'll get your money back the next morning. When doubt crept in, the lending stopped. This freeze created immediate problems for several financial institutions. Two hedge funds managed by Bear Stearns, one of Wall Street's most prestigious investment banks, had borrowed heavily to buy mortgage-backed securities and CDOs. When the asset-backed commercial paper market froze and the value of their holdings started to fall, the funds faced margin calls. They couldn't meet them. In July 2007, the two Bear Stearns hedge funds collapsed, telling investors they would get little, if any, of their money back. Losses were estimated at $1.6 billion. The collapse of the Bear Stearns hedge funds was another tremor, stronger than New Century, but still not quite strong enough to shake the broader market awake. Bear Stearns itself was still operating. Most banks were still reporting solid earnings. The crisis seemed contained to a few over-leveraged hedge funds and some poorly managed subprime lenders. Surely, people told themselves, the big banks knew what they were doing. They had sophisticated risk management systems. They were too smart to have made the same mistakes as these smaller players. But the smart money, the people who really understood what was in those CDOs and mortgage-backed securities, were starting to get very worried. Some investors, a small group often called the prescient few, had actually been betting against the mortgage market for months or even years. They had purchased a particular kind of derivative called a credit default swap, which essentially functioned as insurance against mortgage-backed securities defaulting. These investors including hedge fund managers like Michael Burry and Steve Eisman, whose stories would later be dramatized in the book and film The Big Short, had studied the underlying mortgages and concluded that the default rates were going to explode. They had shorted the housing market, making bets that would pay off handsomely if the mortgage-backed securities failed. For a long time, these investors had looked foolish. The housing market kept chugging along. The securities they were betting against kept paying their coupons. Their investors and colleagues thought they were crazy, throwing money away on a contrarian bet that seemed to go against all the evidence. But in 2007, as defaults started to rise and housing prices started to fall, their bets finally began to pay off. The credit default swaps they had purchased started to rise in value. The market was slowly, painfully, beginning to recognize what they had seen all along: that the emperor had no clothes, that the AAA ratings were fantasy, that the whole edifice was built on sand. By the fall of 2007, the signs of trouble were impossible to ignore. More mortgage lenders were failing. The ABX index, a benchmark that tracked the value of subprime mortgage-backed securities, was plummeting. In October and November, the CEOs of Merrill Lynch and Citigroup resigned after reporting multi-billion-dollar losses and CDO downgrades. These weren't small regional banks or hedge funds anymore. These were giants of Wall Street, institutions that had been around for decades, suddenly admitting they had huge problems. The Federal Reserve, watching these developments with growing alarm, began cutting interest rates. In September 2007, the Fed cut the federal funds rate for the first time since 2003, lowering it from 5.25% to 4.75%. It was a signal that the Fed was concerned, that it saw trouble ahead, and was trying to get ahead of it. Over the next several months, the Fed would cut rates repeatedly, trying to ease financial conditions and keep credit flowing through the system. But lower interest rates couldn't solve the fundamental problem. The problem wasn't just that credit was tight. The problem was that trillions of dollars in securities were backed by mortgages that were going bad, and no amount of rate cuts could change that underlying reality. All across America, particularly in states like California, Florida, Arizona, and Nevada, homeowners were starting to default in larger numbers. Their teaser rates had expired, their monthly payments had jumped, and in a falling housing market, they couldn't refinance or sell their way out of trouble. They were stuck, underwater on mortgages they couldn't afford, in houses that were worth less than they owed. The foreclosure process began slowly, almost invisibly at first, but then with gathering momentum. A notice taped to a door, a family packing their possessions into a U-Haul, leaving behind the dream they had borrowed so heavily to achieve. An empty house, windows dark, lawn slowly going brown. One foreclosure became 10, then 100, then thousands. In some neighborhoods, entire streets were lined with empty homes, their for sale signs fading in the sun. Each foreclosure added to the inventory of homes for sale, which put further downward pressure on prices. And as prices fell, more homeowners found themselves underwater, owing more than their homes were worth, which made default more likely even for people who could still afford their payments. Why keep paying a mortgage on a house worth $200,000 when you owe $400,000? Some people walked away, deciding that strategic default made more financial sense than continuing to pay. This added more homes to the inventory, which pushed prices down further, which created more underwater mortgages. It was a vicious cycle, a downward spiral that fed on itself. The financial institutions holding mortgage-backed securities and CDOs watched in growing horror as the default rates climbed month after month. The models that had predicted low default rates were being proven wrong, dramatically wrong. Securities that were supposed to be safe were hemorrhaging value. And because these securities had been sold all over the world, the crisis was spreading beyond America's borders. Banks in Europe, in Asia, in Australia discovered they were holding securities that were suddenly worth a fraction of what they had paid. Pension funds reported massive losses. Insurance companies saw their balance sheets deteriorate. The contagion was spreading through the interconnected global financial system like a virus, moving from institution to institution, from market to market, carried by the very instruments that were supposed to have made the system safer through diversification. By the end of 2007, it was clear that this was no longer just a subprime problem. This was becoming a broader financial crisis. The question was no longer whether the housing market would have a soft landing. The question was how bad the crash would be and how much damage it would cause to the rest of the economy. But even then, even as the evidence mounted and the losses multiplied, most people still didn't grasp the full scope of what was coming. They didn't understand that the worst was still ahead, that 2008 would bring a cascade of failures and near failures that would bring the financial system to the edge of collapse. That's where we're going next, to the moment when everything almost stopped, to the fall of 2008, when panic replaced confidence and the unthinkable became real. The year 2008 began with anxiety, but not yet panic. The stock market had ended 2007 lower than it started, but the decline wasn't catastrophic. Some optimists even argued that the worst was over, that the market had adjusted to the new reality and would now stabilize. This hope would prove tragically premature. What came next was a cascade of failures and near failures that would accelerate through the spring and summer before reaching a climax in September, a month that would fundamentally transform the global financial landscape. The first major domino fell on a cold weekend in March. Bear Stearns, the venerable investment bank that had survived the Great Depression and dozens of market crises over its 85-year history, was hours away from bankruptcy. The immediate cause was a classic bank run, but instead of depositors lining up outside branches to withdraw their money, this was a modern run. Bear Stearns relied heavily on short-term borrowing, particularly the overnight lending markets, to finance its operations. When confidence in the firm evaporated, these lenders pulled back. Within days, Bear Stearns went from appearing healthy to being insolvent. It couldn't fund its daily operations. Without immediate help, it would have to file for bankruptcy when the markets opened on Monday. The Federal Reserve, understanding that Bear Stearns' failure could trigger a wider panic, orchestrated an emergency rescue. Over a frantic weekend of negotiations, JP Chase agreed to purchase Bear Stearns for the fire sale price of $2 per share, a price later raised to $10 per share. To sweeten the deal and make it possible, the Federal Reserve provided $30 billion in financing, essentially guaranteeing that JP Morgan wouldn't lose money on Bear Stearns' toxic assets. The rescue of Bear Stearns was extraordinary. The Federal Reserve had never before intervened to save a non-bank investment firm. But Fed Chairman Ben Bernanke and Treasury Secretary Henry Paulson believed that allowing Bear Stearns to fail would have been catastrophic. The firm had hundreds of billions of dollars in contracts with other financial institutions. Its sudden failure would have left those counterparties with massive losses and could have triggered a domino effect of failures throughout the system. So they stepped in, using the Fed's emergency lending powers to arrange a shotgun marriage and prevent a bankruptcy. The rescue calmed markets temporarily, but it also created a new kind of uncertainty. If the government had stepped in to save Bear Stearns, would it do the same for other firms in trouble? Did some institutions have an implicit government guarantee? The phrase "too big to fail" entered the national conversation. It referred to the idea that certain financial institutions were so large and so interconnected that their failure would cause unacceptable damage to the broader economy. Therefore, the government would be forced to rescue them, even if it didn't want to. This created what economists call moral hazard. If firms believed they would be rescued if they got into trouble, they might take bigger risks. Why not? If the bets paid off, they kept the profits. If the bets failed, the taxpayers would absorb the losses. It was heads we win, tails you lose. Critics argued that this was exactly the wrong message to send. But defenders countered that in the midst of a crisis, with the financial system teetering, moral hazard concerns had to take a back seat to preventing a complete meltdown. Through the spring and early summer of 2008, the crisis seemed to stabilize. The Fed continued cutting interest rates. Banks reported losses but remained operational. Housing prices continued falling, but gradually. The economy was in recession. Technically, it had entered recession in December 2007, but not a severe one yet. Unemployment was rising but was still relatively low, around 5 or 6%. There was a sense that maybe, just maybe, the system could weather this storm without complete catastrophe. But beneath the surface, the pressure was still building. The crisis was moving from the mortgage market to other parts of the financial system. Banks and investment firms, having suffered huge losses on their mortgage-related securities, were trying to deleverage, meaning they were selling assets and reducing their borrowing to shore up their capital positions. But when everyone tries to sell at the same time, prices fall, which means more losses, which means more selling. Another vicious cycle. In July, the crisis claimed another victim. IndyMac Bank, a large mortgage lender, failed. It was the second largest bank failure in American history up to that point. The FDIC seized its assets and took over operations. Lines formed outside IndyMac branches as depositors rushed to withdraw their money. The images were disturbing, reminiscent of the bank runs of the Great Depression, scenes that Americans thought belonged to history books, not to the present day. Then in early September, the crisis entered its acute phase. On September 7th, the government took over Fannie Mae and Freddie Mac, the two giant mortgage companies that together guaranteed about half of all mortgages in the United States. Fannie and Freddie weren't strictly government agencies, but they had been created by Congress and were widely assumed to have an implicit government guarantee. When they started to falter under the weight of mortgage losses, the government made that guarantee explicit. Treasury Secretary Paulson announced that the government would inject capital into both companies and guarantee their debt. The cost would eventually reach nearly $190 billion. The takeover of Fannie and Freddie was supposed to calm the markets. Instead, it raised more questions. If even these giant government-backed institutions were in trouble, who was safe? And the answer to that question was becoming clearer with each passing day. No one was safe. The following weekend, September 13th and 14, 2008, would later be described as the most consequential weekend in the history of American finance. Multiple crises converged at once. Lehman Brothers, another venerable Wall Street investment bank, was on the brink of collapse. Like Bear Stearns before it, Lehman had made heavy bets on mortgage-related securities. As those securities lost value, Lehman's capital eroded. Its stock price plummeted. Its counterparties began pulling back, refusing to lend or demanding more collateral. A death spiral was underway. At the same time, Merrill Lynch, another major investment bank, was in serious trouble. Bank of America was negotiating to acquire Merrill, but the deal was uncertain. And AIG, American International Group, one of the largest insurance companies in the world, was facing its own crisis. AIG had sold hundreds of billions of dollars worth of credit default swaps, essentially insurance on mortgage-backed securities. As those securities declined in value, AIG was facing enormous claims and didn't have enough capital to pay them. That weekend, government officials, led by Treasury Secretary Paulson and Federal Reserve Chairman Bernanke, convened emergency meetings at the New York Federal Reserve Bank. They brought together the heads of major Wall Street firms, trying to find private sector solutions to these crises. The atmosphere was tense. Everyone understood that what happened over the next 48 hours could determine the fate of the entire financial system. The government officials made a fateful decision. They would not provide government money to rescue Lehman Brothers. Unlike Bear Stearns, Lehman would have to find a private buyer or file for bankruptcy. The reasons for this decision remain debated. Some say the government didn't have the legal authority to rescue Lehman without congressional approval. Others say Paulson and Bernanke wanted to draw a line to show that not every troubled firm would be bailed out, to restore some discipline to the market. Still others say they simply misjudged how bad Lehman's failure would be. Two potential buyers emerged: Bank of America and Barclays, a British bank. But Bank of America ultimately decided to buy Merrill Lynch instead, judging Merrill to be in better shape than Lehman. And Barclays pulled out after British regulators, worried about the risks, refused to approve the deal without a shareholder vote, which couldn't happen fast enough. By Sunday evening, it was clear no buyer would emerge. Lehman Brothers would file for bankruptcy when the sun rose on Monday. In the early hours of Monday, September 15, 2008, Lehman Brothers Holdings Inc. filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy in American history. with $639 billion in assets and $613 billion in debt. The news hit the markets like a thunderbolt. The Dow Jones Industrial Average fell 504 points, its largest decline since September 11, 2001. But the point drop was only the beginning. The real damage was happening beneath the surface, in the vast web of interconnections that tied Lehman to the rest of the financial system. Lehman had been a major player in the derivatives market, with over 900,000 derivative transactions, with an estimated notional value of $35 trillion. When it filed for bankruptcy, all of those contracts were suddenly in doubt. Who owed what to whom? What were the securities backing those contracts really worth? Panic spread as traders and risk managers at other firms tried to figure out their exposure to Lehman. The uncertainty was paralyzing. Money market funds, which millions of Americans used as ultra-safe places to park their cash, began to experience runs. One fund, the Reserve Primary Fund, had invested heavily in Lehman's commercial paper. When Lehman failed, the Reserve Primary Fund broke the buck, meaning its shares fell below the supposedly guaranteed $1 value. Investors in money market funds, suddenly worried their money wasn't safe, began demanding their cash back. Over the next few days, nearly $200 billion flowed out of money market funds. It was a massive run, and it threatened to shut down the commercial paper market, which companies used to fund their day-to-day operations. If the commercial paper market froze, healthy companies like General Electric or McDonald's wouldn't be able to make payroll or buy inventory. The crisis would spread from Wall Street to Main Street. On September 16th, the day after Lehman filed for bankruptcy, the government reversed course on its no bailout stance, at least partially. AIG, the insurance giant, was hours away from failure. Unlike Lehman, the government decided AIG was too interconnected to fail. AIG had sold credit default swaps to major banks all over the world. If AIG went down, those banks would face huge losses, possibly triggering a cascade of failures. So the Federal Reserve provided AIG with an $85 billion loan, later expanded multiple times, eventually totaling over $180 billion. In exchange, the government took 80% ownership of the company. The contrast was stark, and it angered many people. Lehman, with its 25,000 employees worldwide, was allowed to fail. AIG, whose executives had made reckless bets on mortgage-backed securities, was rescued with taxpayer money. The decision seemed arbitrary, unfair. Why save some firms and not others? Government officials argued they had no choice with AIG, that its failure would have been catastrophic. But to ordinary Americans watching this unfold on their television screens, it looked like Wall Street was being protected while regular people were suffering. And suffer they were. By mid-September, the stock market was in free fall. The Dow would lose more than 3,600 points, over 20% of its value, in the weeks following Lehman's bankruptcy. Retirement accounts, college savings, the nest eggs millions of families had spent years building, were evaporating. The unemployment rate, which had been 5% at the start of the year, was climbing rapidly and would eventually peak above 10%. Foreclosures continued to mount. The recession that had begun mildly at the end of 2007 was intensifying into the worst economic contraction since the Great Depression. On September 25th, Washington Mutual, the largest savings and loan in the United States, failed. It was seized by the FDIC and sold to JP Morgan Chase. With $307 billion in assets, it became the largest bank failure in American history. A few days later, Wachovia, another major bank, was on the brink of failure. The government arranged its sale to Wells Fargo. The two largest remaining independent investment banks, Goldman Sachs and Morgan Stanley, converted to bank holding companies, subjecting themselves to more regulation, but gaining access to emergency lending from the Federal Reserve. The model of the large independent investment bank, a fixture of Wall Street for decades, essentially died in the fall of 2008. Credit markets, the plumbing of the financial system, seized up. Banks stopped lending to each other because they didn't know which banks might be the next to fail. The LIBOR-OIS spread, a measure of stress in the interbank lending market, spiked to unprecedented levels. This spread measures the difference between the rate banks charge each other for loans and the rate on essentially risk-free government securities. In normal times, it's small, just a few basis points. In October 2008, it exploded to over 350 basis points. Banks were hoarding cash, refusing to lend even overnight, even to other banks. This credit freeze threatened to choke off the entire economy. Businesses rely on short-term credit to meet payroll, buy supplies, manage cash flow. If that credit disappeared, companies would start failing not because they were unprofitable, but simply because they couldn't access the cash they needed to operate. This is what's called a liquidity crisis, and it can quickly turn into a solvency crisis, where fundamentally sound businesses become insolvent simply because they can't get credit. The fear in the markets was palpable. Traders described it as unlike anything they had experienced. Even veterans who had lived through the 1987 crash or the bursting of the dot-com bubble said this was different. This wasn't just a stock market crash. This was a crisis of confidence in the entire financial system. People were pulling money out of banks, out of money market funds, out of anything that wasn't insured by the government. The velocity of money, the rate at which money circulates through the economy, was collapsing. People were stuffing cash in mattresses, figuratively and sometimes literally. Overnight, the United States and much of the world had gone from a functioning market economy to something that resembled a barter system in some sectors, with trust and credit, the lubricants of commerce, drying up. Policymakers were in uncharted territory. The tools they had used in past recessions, cutting interest rates, providing temporary liquidity support to banks, weren't sufficient. This crisis was too deep, too systemic. They needed something more dramatic. And that's what led to one of the most controversial and consequential policy interventions in American history: the Troubled Asset Relief Program, known as TARP. But before we talk about TARP and the government's response, let's pause and reflect on what had just happened. In the space of a few weeks, the financial world had been turned upside down. Institutions that had seemed permanent had vanished. Markets that had functioned smoothly for decades had frozen. And millions of ordinary people, far from Wall Street, were about to discover that the chaos in distant trading floors would soon reach them in the form of lost jobs, foreclosed homes, and shattered financial security. In the last week of September 2008, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke made an urgent trip to Capitol Hill. They had come to convince Congress to authorize a massive bailout of the financial system. What they proposed was unprecedented in its scope. They wanted Congress to give the Treasury Department authority to spend up to $700 billion to purchase toxic assets from failing financial institutions. The goal was to remove these troubled assets from banks' balance sheets, allowing them to start lending again and preventing a complete collapse of the credit markets. The proposal, which would become known as TARP, the Troubled Asset Relief Program, was met with shock, anger, and deep skepticism. $700 billion was an almost incomprehensible sum. To put it in perspective, it was roughly 5% of the entire US GDP at the time, and the plan came with very few details. How would the assets be valued? Which institutions would be helped? What oversight would exist? Paulson was essentially asking for a blank check, arguing that time was too short for careful deliberation, that the system was hours away from complete meltdown. Lawmakers from both parties were furious. Their constituents were calling and emailing in droves, overwhelmingly opposed to what they saw as a bailout of Wall Street fat cats who had caused the crisis through their own greed and recklessness. Why should taxpayer money go to rescue the very banks that had crashed the economy? Why should the executives who had made bad bets and earned millions in bonuses be saved while ordinary Americans were losing their homes? The anger was visceral and largely bipartisan. This wasn't a left-right issue, it was an elite versus everyone else issue. But Bernanke, normally a soft-spoken academic, delivered a stark warning in the closed-door meetings with lawmakers. If Congress didn't act, he said, there might not be an economy on Monday. The financial system was on the verge of complete collapse. If the credit markets stayed frozen, businesses would start failing en masse. Unemployment would spike. The recession would become a depression. This wasn't hyperbole. This was the considered judgment of the man who had spent his academic career studying the Great Depression, who understood better than almost anyone how financial crises could spiral out of control if not aggressively addressed. The choice facing Congress was brutal. Vote for a deeply unpopular bailout of Wall Street, knowing it could end your political career. Or vote no and risk plunging the country into an economic catastrophe. It was a choice between terrible and unthinkable, and the clock was ticking. The first vote came on September 29, 2008. The House of Representatives rejected the bailout bill 228 to 205. Both Democrats and Republicans voted against it in large numbers, unwilling to explain to their constituents why they were sending $700 billion to Wall Street. The stock market reacted immediately. The Dow Jones fell 777 points, its largest single-day point drop in history. Over $1.2 trillion in market value vanished in a single day. The message was clear. The markets believed the bailout was necessary, and without it, things would get even worse. The Senate quickly passed a revised version of the bill, adding provisions designed to make it more palatable, including an increase in FDIC insurance coverage and some additional oversight mechanisms. The House, sobered by the market's reaction and under intense pressure from leaders of both parties and from President George W. Bush, voted again on October 3rd. This time, the bill passed 263 to 171. President Bush signed it into law within hours. TARP was now reality. The initial concept was that Treasury would buy troubled mortgage-backed securities directly from banks, removing them from balance sheets and providing liquidity. But almost immediately, this plan ran into problems. How do you price assets that have no functioning market? If you pay too much, you're giving the banks a gift. If you pay too little, the banks get no relief and might fail anyway. The valuation problem proved intractable. So Treasury Secretary Paulson, just weeks after the bill passed, announced a major shift. Instead of buying troubled assets, Treasury would use TARP funds to inject capital directly into banks by purchasing preferred stock. This would strengthen banks' balance sheets, allowing them to absorb losses and continue lending. It was a more direct approach, and it mirrored what Britain had just announced it would do. Over the following weeks and months, Treasury would invest hundreds of billions of dollars in banks large and small across the country. 9 of the largest banks were essentially forced to accept TARP money. On October 13, 2008, Paulson summoned the CEOs of Bank of America, JP Morgan Chase, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, Merrill Lynch, Bank of New York Mellon, and State Street to a meeting in Washington. He told them they were all receiving capital injections, whether they wanted them or not. The logic was that if only troubled banks took TARP money, it would stigmatize them and cause a run. But if all the major banks took money, there would be no stigma. It was forced medicine for the system. The capital injections stabilized the banking system, at least partially. Banks that might have failed survived. The credit markets, while still strained, began to function again. But TARP remained deeply controversial. The program eventually expanded beyond just banks to include helping auto companies like General Motors and Chrysler, which were facing bankruptcy, and to support mortgage modification programs designed to help homeowners avoid foreclosure. In total, about $443 billion was disbursed under TARP. Most of it was eventually paid back as banks recovered and repaid their preferred stock with interest. By the time all programs wound down in 2023, the net cost of TARP was estimated at about $31 billion, far less than the original $700 billion authorized. But the dollar cost doesn't capture the full impact of TARP. In political and social terms, the cost was enormous. TARP became a symbol of everything people hated about the bailouts. It looked like a transfer of wealth from taxpayers to Wall Street. The banks that received TARP money continued to pay executive bonuses, including notoriously to AIG executives, triggering public outrage. There was a widespread perception that Main Street had been left to suffer while Wall Street got rescued. This perception, fair or not, fueled the populist movements that would define American politics for years to come, from the Tea Party on the right to Occupy Wall Street on the left. The Federal Reserve was also taking extraordinary actions. Beyond the $85 billion AIG bailout, the Fed launched a series of emergency lending programs with names like the Commercial Paper Funding Facility, the Term Asset-Backed Securities Loan Facility, and the Money Market Investor Funding Facility. These programs were designed to provide liquidity directly to parts of the financial system that were frozen. The Fed was essentially acting as the lender of last resort, not just for banks, but for the entire financial system. In November 2008, the Fed announced it would start purchasing large quantities of mortgage-backed securities and treasury bonds. This was called quantitative easing, or QE. The idea was that by buying these securities, the Fed would inject money into the financial system, lower long-term interest rates, and encourage borrowing and spending. Over the next several years, the Fed would purchase trillions of dollars of securities through multiple rounds of QE. This was uncharted territory. Central banks weren't supposed to directly purchase large quantities of assets like this. But these were extraordinary times, and they demanded extraordinary measures. President Bush, whose administration had overseen the crisis and the initial response, left office in January 2009. The incoming president, Barack Obama, inherited an economy in free fall. By the time he took office, the economy was losing more than 750,000 jobs per month. The unemployment rate would eventually peak at 10% in October 2009. GDP had contracted sharply in the fourth quarter of 2008 and would contract again in early 2009. The stock market would continue falling until March 2009, when the Dow hit a low of around 6,500, down more than 50% from its peak. The Obama administration quickly pushed for additional stimulus, arguing that monetary policy and financial bailouts weren't enough. The economy needed direct fiscal support. In February 2009, Congress passed the American Recovery and Reinvestment Act, a $787 billion stimulus package that included tax cuts, increased government spending on infrastructure and other programs, and aid to state governments. The goal was to inject demand into an economy that was cratering because businesses and consumers had stopped spending. The stimulus was controversial, criticized by conservatives as wasteful government spending and by progressives as too small, given the severity of the crisis. Economic historians would later debate its effectiveness, though most studies suggest it did help cushion the blow and speed the recovery. But at the time, all anyone knew was that the economy was in terrible shape, and the government was trying everything it could think of to stop the bleeding. The international dimension of the crisis was also critical. This wasn't just an American problem. Financial institutions around the world had bought American mortgage-backed securities and CDOs. European banks, particularly in Britain, Germany, and Switzerland, suffered massive losses. Iceland's entire banking system collapsed. Ireland, Spain, Portugal, and Greece would soon face their own sovereign debt crises, creating a years-long European economic crisis that threatened the existence of the euro itself. Governments around the world coordinated their responses. Central banks cut interest rates simultaneously. Governments announced stimulus packages and bank bailouts. There was a recognition that this was a global crisis requiring global solutions, though the coordination was far from perfect. By the middle of 2009, the acute phase of the crisis had passed. Banks were no longer failing every week. Credit markets had unfrozen, though they remained tighter than before the crisis. Stock markets had stopped falling and had actually begun a recovery that would, over the next decade, see them climb to new record highs. The recession officially ended in June 2009, though the recovery would be painfully slow. But even as the financial system stabilized, millions of ordinary people were still suffering. The unemployment rate, while it had stopped rising, remained stubbornly high. Jobs were scarce. Those lucky enough to have employment often faced pay cuts or reduced hours. The housing market continued to struggle. Foreclosures didn't stop. In fact, they continued at elevated rates for years. Between 2007 and 2012, there were approximately 4 million completed foreclosures in the United States. Millions more families were in some stage of the foreclosure process or were seriously behind on their mortgage payments. Entire neighborhoods were transformed by the crisis. In cities like Las Vegas, Phoenix, and parts of Florida and California, streets that had once bustled with life now had rows of empty homes, their windows dark, lawns overgrown, sometimes vandalized or stripped by scavengers. The human cost of the crisis was staggering. Families that had saved for years to buy their homes now watched as those homes were taken away. Retirement savings, often heavily invested in the stock market, had been cut in half or more. People who had planned to retire found they couldn't afford to. Young people graduating into the worst job market in decades struggled to find any employment, much less careers that matched their education. The crisis didn't just destroy wealth, it destroyed confidence, security, and for many, faith in the system itself. There was also a racial dimension to the crisis that often got overlooked. Studies later showed that minority borrowers had been disproportionately steered into subprime mortgages, even when they qualified for prime loans. The foreclosure crisis hit communities of color particularly hard, wiping out generational wealth and widening the already substantial wealth gap between white families and families of color. The crisis, in this sense, exacerbated existing inequalities rather than affecting everyone equally. The psychological toll was also profound. Depression, anxiety, and stress-related illnesses rose. Suicide rates increased. Studies found elevated rates of domestic violence and family breakdowns during the crisis and its aftermath. The financial stress didn't just affect bank accounts. It affected mental health, physical health, relationships, and community cohesion. Children who grew up during the crisis, who watched their parents lose jobs and homes, who had to change schools or move in with relatives, carried those experiences with them, shaping their attitudes about money, risk, and trust in ways that researchers are still studying. The government's response to the housing crisis itself was widely criticized as inadequate. While billions went to bail out banks, relatively little was done to help homeowners facing foreclosure. Programs like the Home Affordable Modification Program, or HAMP, which was supposed to help people modify their mortgages to more affordable terms, helped far fewer families than initially promised. Many homeowners found the process confusing and frustrating, often ending in foreclosure anyway despite months of effort. There was a widespread perception that the government had saved Wall Street but abandoned Main Street. This perception would have lasting political consequences. The Tea Party movement, which emerged in 2009, was fueled in part by anger over the bailouts and government spending. Occupy Wall Street, which emerged in 2011, was driven by anger at income inequality and the perception that the wealthy had been protected while ordinary people suffered. These movements, though ideologically opposed, shared a common thread of populist anger at elites, at the establishment, at a system that seemed rigged in favor of the powerful. This anger would reshape American politics for years to come, contributing to electoral outcomes and policy debates that continue to this day. As the immediate crisis receded and policymakers began to assess what had happened and how to prevent it from happening again, attention turned to regulatory reform. The financial system had nearly collapsed. Surely something needed to be done to make sure this couldn't happen again. But what, and how much, and at what cost to the economy? These questions would dominate the policy debate for the next several years, eventually leading to the most comprehensive financial reform legislation since the Great Depression. Let's talk about those reforms and what they did and didn't accomplish. By 2010, the financial system had stabilized enough that policymakers could turn their attention from crisis management to prevention. The question on everyone's mind was how to restructure the regulatory framework to prevent another crisis. What had gone wrong? Why hadn't the existing regulations been sufficient? And what new rules were needed? The result of this debate was the Dodd-Frank Wall Street Reform and Consumer Protection Act, named after Senator Chris Dodd and Representative Barney Frank, the chairman of the Senate Banking Committee and House Financial Services Committee, respectively. Dodd-Frank, signed into law by President Obama on July 21, 2010, was a massive piece of legislation. The law itself ran to 848 pages and required regulators to create 243 new rules. It touched nearly every aspect of the financial system, from how banks calculate their capital requirements, to how mortgages are underwritten, to how derivatives are traded. The stated goals were to promote financial stability, protect consumers, and ensure that taxpayers would never again have to bail out failing financial institutions. One of the most significant provisions was the creation of the Financial Stability Oversight Council, or FSOC, chaired by the Treasury Secretary and including all the major financial regulators. The FSOC's job was to identify and monitor systemic risks, the kind of interconnected threats that could bring down the entire financial system. It had the power to designate certain non-bank financial institutions as systemically important financial institutions, or SIFIs, which would subject them to enhanced regulation and oversight by the Federal Reserve. The idea was to prevent a repeat of the AIG situation, where an insurance company's activities in the derivatives market created systemic risk that regulators didn't adequately understand or monitor. Dodd-Frank also gave regulators new tools to deal with failing financial institutions through its orderly liquidation authority. Before the crisis, if a large, interconnected financial firm like Lehman Brothers failed, regulators basically had two choices: bail it out or let it go through bankruptcy, with all the chaos that might entail. The Orderly Liquidation Authority created a third option, a special resolution process where regulators could take over a failing firm, wind down its operations in an orderly way, impose losses on shareholders and creditors, and do so without triggering the kind of panic that Lehman's bankruptcy had caused. This was meant to end too big to fail by ensuring that even very large institutions could be allowed to fail without destroying the financial system. The law imposed stricter capital requirements on banks, forcing them to hold more high-quality capital as a buffer against losses. It also introduced new leverage requirements and stress testing, where banks would have to demonstrate that they could survive severe economic scenarios without failing. These provisions were designed to make banks more resilient, less likely to fail even if the economy turned sharply downward. The Volcker Rule, named after former Federal Reserve Chairman Paul Volcker, prohibited banks from engaging in proprietary trading, meaning trading for their own profit rather than on behalf of customers. The rule was based on the idea that banks that take insured deposits shouldn't be allowed to gamble with those deposits in risky trading activities. If they wanted to engage in proprietary trading, they could do so only in separate entities that weren't backed by deposit insurance. The Volcker Rule proved controversial and difficult to implement, with fierce debates over exactly what counted as proprietary trading versus legitimate market making. Dodd-Frank also addressed the derivatives market, those complex financial instruments like credit default swaps that had played such a big role in the crisis. The law required many derivatives to be traded on exchanges and cleared through central clearinghouses rather than traded privately between parties. This would increase transparency and reduce the kind of counterparty risk that had nearly brought down AIG. It wasn't a complete overhaul of the derivatives market, but it was a significant change from the largely unregulated over-the-counter market that had existed before. Perhaps the most popular provision of Dodd-Frank among consumers was the creation of the Consumer Financial Protection Bureau, or CFPB. This new agency, housed within the Federal Reserve but with substantial independence, was given broad authority to write and enforce rules protecting consumers in financial transactions. This included everything from credit cards to mortgages to payday loans. The CFPB was born out of the recognition that many of the predatory lending practices that fueled the housing bubble had gone unchecked because consumer protection was fragmented among multiple agencies, none of which had it as their primary mission. The CFPB consolidated these authorities in one place. The CFPB wrote rules requiring mortgage lenders to verify borrowers' ability to repay loans, ending the ninja loans, and other obviously unsustainable products. It banned certain practices it deemed abusive and gave consumers clearer disclosures about the terms of their mortgages. The agency became a lightning rod for political controversy, with supporters praising it as a necessary check on financial industry abuses, and critics arguing it had too much power with too little oversight. Dodd-Frank didn't solve every problem. Many critics, particularly on the progressive left, argued it didn't go far enough. It didn't break up the big banks, which if anything had gotten even bigger as they absorbed failing competitors during the crisis. It didn't restore the Glass-Steagall Act, the Depression-era law that had separated commercial banking from investment banking and had been repealed in 1999. It didn't fundamentally restructure executive compensation practices at banks, even though misaligned incentives had played a role in the crisis. Critics on the right and from the financial industry argued that Dodd-Frank went too far, imposing burdensome regulations that made it harder for banks to lend and for the economy to grow. Community banks in particular complained that they were subject to many of the same regulations as giant Wall Street firms, even though they hadn't caused the crisis and didn't pose systemic risks. The cost of compliance, they argued, was forcing small banks to consolidate or go out of business. The implementation of Dodd-Frank was slow and contentious. Many rules took years to write and finalize. The agencies tasked with writing these rules were often understaffed and faced fierce lobbying from the financial industry. Some provisions were weakened or delayed during the rulemaking process. And as time passed and memories of the crisis faded, political support for tough regulation waned. In 2018, Congress passed and President Trump signed the Economic Growth, Regulatory Relief, and Consumer Protection Act, which rolled back some provisions of Dodd-Frank, particularly for smaller and mid-sized banks. Internationally, the crisis also prompted reforms. The Basel III Accords, an international agreement on bank capital standards, were adopted by countries around the world, requiring banks to hold more and higher quality capital and to maintain better liquidity buffers. European regulators implemented their own reforms, though the subsequent Eurozone crisis complicated and in some ways overshadowed those efforts. But regulatory reform alone couldn't undo the damage of the crisis. The economy recovered eventually, but it was a long, slow recovery. GDP growth averaged only about 2% per year in the first several years after the recession ended, well below historical averages. The unemployment rate declined steadily, but took years to return to pre-crisis levels. And the jobs that came back weren't always the same ones that had been lost. Many of the new jobs were lower paying, in service industries rather than manufacturing or construction. This contributed to a sense that the recovery wasn't reaching everyone equally. Household wealth, which had fallen by about $16 trillion during the crisis, slowly recovered, at least in aggregate. But this recovery was uneven. Those who had significant assets in the stock market saw their wealth recover and eventually exceed pre-crisis levels as the stock market soared. Those whose wealth was primarily in their homes, particularly those who had been foreclosed on or remained underwater on their mortgages, saw much slower or non-existent recovery. The wealth gap, already substantial before the crisis, widened further. The housing market took years to heal. Prices in many markets didn't return to their pre-crisis peaks until the mid-2010s, and in some hard-hit areas, prices never fully recovered. First-time home ownership rates fell dramatically and remained low for years, as young people, burdened with student debt and lacking down payment savings, found it harder to buy homes than previous generations had. The crisis, in this sense, altered the trajectory of an entire generation's economic lives. There were broader cultural and psychological impacts too. Trust in institutions, already declining before the crisis, fell further. People lost faith in banks, in rating agencies, in regulators, in government, in the ability of experts to manage complex systems. The idea that markets were self-regulating and that deregulation was always beneficial took a serious hit. But so did trust in government interventions, as many people saw the bailouts as benefiting the connected and powerful at the expense of ordinary citizens. The crisis also changed the practice of economics and finance. The mainstream macroeconomic models that had been used before the crisis which largely ignored the financial sector and didn't account for the possibility of major financial crises, were discredited. New models that incorporated financial stability and systemic risk gained prominence. Central banks around the world began paying much more attention to financial stability as a policy goal alongside their traditional focuses on inflation and employment. In the financial industry itself, attitudes changed, at least to some degree. Risk management received more attention. Stress testing became standard practice. Banks held more capital and were more cautious about leverage. But human nature didn't change. The incentives that had driven excessive risk-taking, the desire for short-term profits, the tendency toward overconfidence during good times, these remained. And as the years passed and the crisis receded into memory, some of the old behaviors began to creep back. Perhaps the most important lesson of the crisis, though it's one that seems to need relearning in every generation, is that financial crises are not aberrations. They are not once-in-a-century events that can be safely ignored when making plans and policies. Throughout history, from the tulip mania of the 1600s to the South Sea bubble, to the panics of the 19th century, to the Great Depression, to the savings and loan crisis, to the dot-com bubble, financial systems have repeatedly experienced booms and busts. The details differ, but the pattern is depressingly similar. A period of innovation and growth leads to overconfidence. Leverage increases, risk is underestimated. Eventually something breaks, and the correction is swift and painful. The 2008 crisis was not unique in this pattern. What made it particularly severe was the combination of factors: the size of the housing bubble, the complexity and opacity of the financial instruments built on top of it, the interconnectedness of the global financial system, the high levels of leverage throughout the system, the failures of regulation and rating agencies. All of these came together to create a perfect storm. And when the storm hit, it revealed how fragile the whole edifice had been all along. The crisis also revealed uncomfortable truths about inequality and power. The financial system had become increasingly concentrated, with a small number of very large institutions dominating. When those institutions got into trouble, their failure threatened everyone, giving them enormous leverage over policymakers. This was the essence of too big to fail. Not just that the institutions were large, but that they were so interconnected with the rest of the economy that their failure would cause unacceptable collateral damage. This gave them a kind of veto power, an ability to take risks knowing that they would likely be rescued if things went wrong. Dodd-Frank tried to address this, but it's not clear it succeeded. The largest banks are even larger now than they were before the crisis. There's also the question of accountability. Very few people were held criminally accountable for the crisis. Some firms paid large fines, but these were often negotiated settlements with no admission of wrongdoing and no individuals charged. This lack of accountability fed public anger and the perception that there was one set of rules for Wall Street and another for everyone else. Some argue that much of what happened wasn't actually illegal, just reckless and foolish. Others argue that prosecutors didn't try hard enough, that powerful interests were protected. The truth probably lies somewhere in between, but the result was the same. The people who made the decisions that led to the crisis, who earned millions in bonuses during the boom years, largely kept their money and their freedom. As we look back now, more than 15 years after Lehman Brothers fell, the crisis feels both distant and present. Distant in that the acute panic, the daily fear that the financial system might collapse, has faded. The economy recovered. The stock market set new records. Unemployment fell back to low levels. Life, for most people, returned to something resembling normal. But present in that the impacts of the crisis, the increased inequality, the lost trust, the political divisions, the burden of debt, continue to shape our world. Young people who entered the job market during the recession often never caught up, earning less over their careers than they would have in a stronger economy. Communities that were devastated by foreclosures never fully recovered, with lower home ownership rates and weaker social ties. The populist anger that the crisis unleashed continues to roil politics in the United States and around the world. And the fundamental vulnerabilities that led to the crisis, while perhaps contained, haven't been eliminated. Financial systems are still complex, still interconnected, still subject to booms and busts driven by human psychology and incentives. We've tried to learn lessons, to build better regulations, to be more vigilant. But whether we've learned enough, whether the reforms will hold when tested, whether we've truly become wiser rather than just more cautious, remains to be seen. Financial crises, after all, don't announce themselves with clear warning signs. They develop gradually, often during periods of apparent prosperity, and they're only obvious in retrospect. The challenge is to remain vigilant during good times, to resist the siren song of easy money and inflated asset prices, to remember that risk is real even when it's invisible. The 2008 financial crisis was a disaster that didn't have to happen. It was the result of choices made by individuals, by institutions, by policymakers, by all of us in ways large and small. It wasn't an act of God or an unforeseeable accident. It was the consequence of a system that prioritized short-term profits over long-term stability, that allowed complexity to hide risk, that failed to ask hard questions when times were good. And when it came crashing down, millions of innocent people paid the price. But from that disaster also came some wisdom, some reform, some recognition of how fragile prosperity can be, and how quickly confidence can turn to panic. The challenge now, as it has always been, is to hold on to that wisdom even as the crisis fades from memory, even as new generations who didn't experience the panic make new decisions, even as the temptation to believe that this time is different once again takes hold. Because the cycle, if we're not careful, if we don't remain vigilant, will repeat. Not in exactly the same way, but in some new form that seems different, but carries the same fundamental risks. So if there's one thing to take away from this long, winding story of the 2008 financial crisis, it's this: financial stability is not natural or automatic. It requires constant attention, appropriate regulation, humility about what we don't know, and a willingness to act against short-term incentives for the sake of long-term security. It requires remembering, even when it's uncomfortable, even when it's politically difficult, that the costs of preventing a crisis are always far less than the costs of cleaning up after one. That's the real lesson of 2008. Whether we've learned it well enough remains to be seen. And on that thought, as the story of the crisis fades into the quietness of reflection, we can rest. The crisis came and went. The system survived, barely, and life, somehow, continued. Tomorrow always comes with new challenges and new hopes. But for tonight, let the weight of these events settle gently. Let the lessons sink in. And let yourself drift into the kind of peace that comes from understanding, at least a little better, how we got from the optimism of the early 2000s to the panic of 2008, and what it cost us all. If you found this helpful, consider subscribing to the channel. There are more stories to tell, more economic puzzles to unravel, more history to explore. Until next time, rest easy, knowing that even in our darkest economic moments, we find ways forward. Sleep well.